In this video, we're going to discuss a concept in making decisions. And this concept is referred to as incremental analysis. And the idea of incremental analysis is to allow us to view alternatives and try to determine which alternative is better, right? We need to pick the best of all the things we can choose. So when we make decisions, we have a lot of things we have to do. So we don't always follow exactly the same pattern, right? Sometimes decisions might vary. They might have different sizes, urgency, priorities, right? But they usually have a process, right? It's not always set, but there's a process. So essentially, we have to identify problems and assign some kind of responsibility. We need to determine what possible courses of action we can pick. Hopefully, we've got more than one. And then we need to make a decision. We have to choose the best of those decisions. And then finally, after the decision, we need to review and see what happened. Did we choose the right one? Do we need to make further kinds of changes in order to make the operations more efficient and more profitable? So again, this is essentially what this analysis is all about, this incremental analysis. We want to look at differences. So if you're making business decisions, one of the things that we have to understand, and we've talked about this in other videos, is that it's not just all about the financial aspect of the question. We also have to include non-financial types of information, right? Sometimes I refer to this sometimes as some collateral damage, right? We make a decision that makes sense on the money side, but it has impact on the other side as well. Maybe it's going to affect our employees so that employees might quit, right? So now we have employee turnover. Maybe there's impact on the environment. Maybe it affects our customers in some way. So we have to be able to incorporate both of these, but these non-financial factors are very difficult to measure and quantify, right? So how do we go about this? We have to understand that sometimes when you make decisions, costs and revenues can change. They can both change or neither, obviously one of them is going to change, right? So we get either only revenues, only costs, or maybe they both will change over time. We've been discussing this when we talk about the differences between variable and fixed costs and mixed costs, right? Even though in the sense that they are fixed and or variable, in different scenarios, when you change the different activity index, right? The amount of production and process we're going to be doing, sometimes those numbers will change. So how incremental analysis works is essentially shown here in this illustration. We have alternative A. Revenues are 125,000, costs are 100,000. In B, revenues are 110 and costs are 80. So how do you find out the differences? What is the differential? Well, for revenues, you take B, column B here, alternative A minus alternative B. That means if you do B, you're going to lose $15,000 of revenue, right? If we do A, we got 125. Subtract B, we end up with a loss of revenue of negative 15,000. For costs, 100,000 minus 80,000 means if we do B, we're actually going to decrease costs. So that means it's an increase in income. So if you look at the two here, obviously if we do project B, we're going to increase revenue by $5,000. Well, why don't we just do 25,000? Why didn't we just do this? And the point is that maybe there are things in here that we can review, right? Maybe we can look at the units. Maybe we can look at the costs. Let's look at the cost structure. Maybe it's different. Maybe we can do something to manage these costs. And if you just look at the bottom line, we don't get enough detail to make that kind of analysis. So what are we looking at? For relevant costs, right? You're looking at the costs and revenues that differ, right? What is different between the two? Opportunity cost. If I do project A, am I giving up something in project B, right? I need to look at opportunities that might be lost by choosing between different projects. And finally, sunk costs. This is just an expense that's incurred, and it's not going to change or be avoided by our particular decision. So really, we only want to look at those things that change. So if we have two projects, A and B, and if the assets that we need are $50,000 for each, right? It doesn't matter which one, they're both $50,000, or they're the same assets. We don't need to include that number in our determination because it doesn't matter. It's not going to affect the difference between the two projects. So again, this idea of incremental analysis is a little strange, but once you get it on paper and you see how it works, it provides us a nice little mechanism for ensuring that we choose the best between some projects. We have already talked about variable costs by themselves. They're supposed to change by units, but typically they don't change between alternatives unless there's something very different about the alternatives themselves. And the only thing I can think of off the top of my head is if we need 30 board feet to make furniture, and the way we make furniture under alternative A is we have about 5 feet of scrap wood when we're done. Under alternative A, we only need to use 25 square feet because we only have 1 foot of scrap. So we're going to use less wood. We have less scrap. That means the variable cost per unit changes. Again, fixed costs are the things that can change. Maybe we use different assets, right? So we need to understand the differences here between variable costs and fixed costs, how they'll change amongst our alternatives. And the one thing to do is to recognize is that this analysis does not incorporate the time value of money. So for a long run kind of a project, we're not going to be able to make very long-term decisions based on this process. So by definition, this is typically a fairly short-term decision process. So what kinds of projects will we look at? Should we accept an order at a special price? Normally we sell things for $50, but somebody says, "Hey, look, we'll buy 12,000 if we can get it for $45." Should we accept the that $45 price? Should we make or buy parts, or should we buy finished products? Right? So should we go out and purchase? For instance, if you think about things in the news lately, we have computer chips, right? Should we go out and purchase those, or should we make those ourselves? Should we sell or process things further? Gasoline makes some sense. I don't really know the process here, but if we start to make something from petroleum, let's say gas is the first thing. Well, we can stop at gas, or we can continue to refine the product and maybe make another petroleum product, if you will. Does it make sense to stop there at the beginning, or should we process even further? Should we repair, retain, or replace equipment? Right? What should we do with our assets? How do we manage that? And finally, maybe we have a business segment, and we wanted to determine whether or not we should keep it or not. So these are the basic projects that we're going to look at over the next few videos, utilizing this incremental analysis process. Look forward to seeing you soon.